Good evening and welcome to the Vanilla Times. Today we're going to talk about the dark clouds that have been gathering on the horizon. For the past 4 years, we have witnessed a remarkable determination on the part of the governments of the United States, Britain, and other major European nations to stabilize their economies by bailing out big banks and financial institutions. Once again, we have Mr. Christopher Aiello with us on the show. So Chris, welcome back to the show and thank you so much for coming. Let's start off by talking about zero interest rate policy. Okay, so you've talked about the zero interest rate policy, or ZIRP, nice acronym. One of the really cool things about the financial markets are these very nice acronyms like ZIRP, like ZIRP, TARP, etc. Anyway, you've talked about the zero interest rate policy, so can you just tell us how long can interest rates remain zero? Maybe like 10 years, 20 years. I mean, in the case of Japan, we've seen that interest rates can be near zero for more than a decade.
Well, to answer that question, let me start off by giving you some context. Ben Bernanke implemented the first round of quantitative easing and zero interest rate policy in March of 2009. So we are already fully 3 years into a zero interest rate policy world. I know this may sound outrageous, but I really would not be surprised at all if we were to see and experience another 10 years of zero interest rates and a zero interest rate policy on the part of the Federal Reserve. While that may sound excessive, there is logic behind my thoughts, and a simple back-of-the-envelope calculation shows that if we look at the current outstanding level of U.S. federal debt, if interest rates were to only increase approximately 2%, the amount of the increase in terms of servicing the outstanding debt would increase by $300 billion US. And there's no way that the US tax revenue base could withstand that kind of increase in terms of the debt service increase. Whether it's a corporation or a government, the coupons in terms of the interest rates have to be paid. So, based on the incredible amount of outstanding debt, I think that the Federal Reserve, as outrageous as it may seem, is going to have to keep interest rates at zero for probably another 10 years, which is much longer than people realize.
So we now have what everybody calls a sovereign debt crisis. So the governments of Italy, Spain, Portugal, and Greece are in a very difficult spot. And a major concern is that many of these governments, especially that of Greece, will default on its loans. So how is this crisis different from the global financial crisis of 2009? Or is it that the sovereign debt crisis is Act 2 or Act 3 of the global financial crisis?
In the beginning of our discussion, I said that it's my personal belief that the global financial crisis is still ongoing, although the characteristics of the crisis have taken many different forms and morphed over time. Act 1 was the subprime credit crisis, which started in 2007. Act 2 was the broader credit and banking crisis of 2008 and 2009. In the previous two episodes of the crisis, we had mortgage originators, mortgage insurers, and investment banks that either were insolvent and went bankrupt or had to be bailed out and nationalized. Where we are today is, in my opinion, Act 3, which, as you said, is a sovereign debt crisis. What makes this part of the crisis so dangerous is that it is governments themselves that are insolvent. And how do you bail out insolvent governments other than through massive money printing, which ultimately becomes very inflationary? Ultimately, I think this is going to lead to Act 4, which will be a currency crisis. And that will happen when both private investors and institutional investors lose their faith and confidence in the ability, or lose their faith and confidence in government policy makers and their ability to manage both monetary and fiscal policy. And when that happens, we're going to have ultimately the final act of this ongoing crisis, which will be a currency crisis. It's my personal belief that ultimately where this leads to is whereby we'll have some type of new Bretton Woods agreement, Bretton Woods 3 if you will, whereby the major global currencies have to be rebased in terms of gold. And when that happens, I think ultimately this ongoing crisis will be over.
Okay, so quite a few market observers, such as you, have alluded to wealth destruction especially in the developed economies such as Europe and America. It's interesting because the other day one of our senior editors was talking to a prominent banker, and he dismissed the talk of wealth destruction as simply mumbo-jumbo by the left-wing politicians. His refrain was, "Look around you. Do you see less wealth or more?" Okay, of course in Asia there's perhaps more wealth creation than destruction. We really don't know. But in general, in the developed economies at least, is this notion of wealth destruction due to the financial crisis or the sovereign debt crisis, or really left-wing mumbo-jumbo?
I would say that the banker who made that comment to your senior editor has a somewhat narrow view of what really happened in 2007 and 2009. Perhaps if that banker had been working for Bear Stearns or Lehman Brothers, which went into bankruptcy, he would have experienced the very real and tangible effects of wealth destruction as his stock options vaporized. Taking a little bigger picture view, had the Federal Reserve not bailed out AIG and forced AIG in turn to pay out 100 cents on the dollar, the failed CDS bets that had been made by Goldman Sachs and Morgan Stanley and about 17 other banks, including European banks, then the effects of tangible wealth destruction would have been felt by him. More specifically, aside from the losses that people have incurred in their portfolio values as equity markets have fallen after 2009, there is a much more subtle and pernicious effect of wealth destruction that is happening today right now. Due to a zero interest rate policy which is being set by the Federal Reserve and other central banks, prudent savers and people who have accumulated savings are being punished for their prudence and their discipline, because a zero interest rate policy doesn't allow them to earn interest income on their accumulated savings. In addition, because of a zero interest rate policy relative to the inflation rate that we have today, we exist in the condition of negative real interest rates, which means that people are actually losing the purchasing power of their money. So I would say to you that wealth destruction and the effects of wealth destruction really are real and tangible based on fundamental economic common sense, and it isn't left-wing mumbo-jumbo that was intimated by the banker that your senior editor spoke with.
Okay, so Bill Gross of PIMCO, amongst other prominent fund managers, have talked about the death of the equity culture. We'll probably talk about this in detail in the later episodes, but right now, very quickly, are the equities truly and finally dead, or have they just gone into stasis?
Well, I have a great deal of respect for Bill Gross, who many consider to be the king of bonds. In many aspects, he may be right. In the decade from 2000 to 2010, there have been two major equity bear markets, and we've had a very persistent and high level of volatility. Over that same 10-year period, the S&P has actually generated negative returns for buy and hold investors, and investors in equities in the S&P actually did worse than investors in bonds and even short-term T-bills. Since the global financial crisis, considered to end around March of 2009, retail investors have been withdrawing massive amounts of money out of equity funds and have been primarily investing in fixed income funds and fixed income products. For myself as a contrarian thinker and trader, anytime I see the market leaning very heavily to one side of the trade, to me that spells opportunity. But I still believe that we're not yet done with the global financial crisis, and I would expect that sometime in the next 18 months we're going to have another major sell-off where it's very highly likely that we will test the lows that markets traced in March of 2009, both in the United States and even here in Asia. Once we get that kind of sell-off, I think the bear market will be over, and it will be time to be long equities for another major bull market cycle. So I would agree with Bill Gross that equities are being shunned and are really not feeling the love at this time. I would not be positioned to be explicitly long equities because I think we're still in the middle of the eye of the hurricane, and sometime in the future we're going to experience both another major recession and another leg down in this current bull market, bear market.
Alright, so to sum it up, are we in any better predicament than we were in 2009?
Well, it's my personal view that the global financial crisis of 2007 and 2009 is in fact still ongoing, and we're really in the middle of the eye of the hurricane. And sooner rather than later, I think we're going to be facing more global recessionary pressures in the economy and more instability in the banking system and global capital markets. To give you some specifics, on the face of it, if we were to look at the rise of equity markets since 2009, we've seen a spectacular rebound in the price of equities and other asset classes. For example, the Standard & Poor's 500 has increased around 50.8% from January 1st until last Friday. However, if I was to reprice the S&P in terms of gold, the S&P is actually down 21% over that same period. So what that means is that financial assets are actually devaluing while gold, which many consider to be real money, is appreciating. And I think the reason for that is many people are starting to realize that the problems that were present going into the global financial crisis are still present and nothing has really been solved. And in fact, many of the structural imbalances in the size of the outstanding debt are actually worse today than it was during the global financial crisis and before. To give you another example, in June of 2009, the total outstanding debt of the United States was approximately $10 trillion US. But due to all of the fiscal stimulus spending that has gone on in the last 3 years, the outstanding debt in the United States has actually increased an additional 15% to approximately $16 trillion. Those are really crazy and mind-boggling numbers, but even though a large number of people think that the global financial crisis has ended, to me that's the reason why we still are experiencing very low levels of economic growth in terms of GDP. We have very stubborn and high levels of unemployment. There are low levels of savings and low levels or even negative growth in terms of income for households. And we live in this really crazy world of zero interest rate policy. So I don't think that things are really structurally better, and I do think that there's more turbulence ahead.
Thank you so much, Chris, for coming to the show. It's always a pleasure having you here.
It's a pleasure to be here again tonight, and thanks very much for having me, and look forward to being with you again.
We'll see you in the next session.